Thank you very much. Up next, we have Mr. Patrick Pfister. I hope I'm pronouncing that wrong. All right. The president of the Swiss Association of Market Technicians, SAMT, from Zurich, Switzerland. Please.
All right, thank you for having me here. Thank you to the organizer of this conference. It's a very pleasure to be here and presenting you about technical analysis. It's also very impressive to have seen David's presentation, and there are a lot of similarities in it. You will recognize them, like the tool set, etc. There was a presentation before we come to the same conclusions. So I want to make it short. You got my contact details here, so if you have questions, feel free to approach me during the conference and email or through LinkedIn as well. Very important, although this is a primer, it's just about education. Whatever you see, I show you lots of techniques, etc. is no financial advice or recommendation, but an example how you can actually invest well. One problem we face in Switzerland is that people say, why shouldn't you join your association? You have to pay money, but everything out there is free of charge. Just go to the internet. Well, I tell you what, if you go into the internet, you'll find lots of strategies, but if you don't understand how to understand or you don't understand how they work, well, you're probably not going to make money. If you learn about technical analysis, I tell you, it's by far, for me, the best education I've ever made. It will set you on a journey that will continue for you for a lifetime, and you can make a better investment with it. So it's really worth. And I also show this uptrend. When you read the first book, you gain some knowledge, but it doesn't end. You always add some more to it, so it's really a journey going on. As Derek Bob said, he's the former president of Harvard University. If you think that education is expensive, try estimating the cost of ignorance.
That's a great expression.
Another not so very serious disclaimer. If you play with your phones or you sleep during my presentation, I couldn't give tomorrow. This is all the important knowledge, is training experience that I will share with you. I started with technical analysis roughly 25 years ago. I learned a lot about it. Some I learned through books, some I paid in a very expensive way through market losses, but it's the best and steepest learning curve you can actually have. So for this presentation, I would like to introduce you to a little character which could be representative for many of you. I call him Joe McMoney. He's a stock investor, or wants to be a stock investor, and he's exactly what I told you. He saw the YouTuber online, 18 years old or 21 years old with roughly 10 years of market experience. He's telling you how to make money. And well, if you me see that, I just want to be the same. So Joe McMoney would like to be like that. Who would like to be like that? Well, probably many of you right now, they're more like that. You don't want that to be. So the question is like, why do we technicians, we have all the tool sets, we know how to invest better than the rest, why we often make losses? The reason is, when you apply tools the wrong way, it will lead you to disaster. You really have to study hard and apply with many examples how to use these tools. Then you get great results. So I summarized from my personal trading experience 4 things, 4 reasons why many people fail at investing. Can you imagine why, especially technicians, why we fail at investing on the losses? What could be one of the reasons that we don't succeed? What do you think? Greed. Greed could be one of the things, yes. Exactly.
It doesn't start with P.
Sorry?
It doesn't start with P. I'm kidding.
That's right, yes. So for me, and I'm sure you will relate to that, number one thing to not miss is patience. When we get in front of the chart and we see a pattern or a trend, and we see, I know I've read it in the book. Now I'm going to go and invest right away. I cannot win. Actually, if you wait until all the signals, all the patterns come together, then you'll actually find the right move. But if you hurry too quickly into buying or selling something, it could be the problem. So here's an example in this light of an artificial intelligence trend that is currently going through the markets, which is actually a browser, but which is using artificial intelligence, has rockets from €4 to nearly 12. 300%. Then technicians go and say, oh, I see this reversal bar plus. It can't go any higher, so let's shorten it. But fact is, it's just the beginning of a very long path. If you short that moment, you will have a big loss. However, if you wait until you really have a clear top, until it culminates, and then you reverse, you make a much better performance. Second is pattern. You really need to clear up your patterns and keep it simple. Okay, this one is a bit excessively, but you need to understand what's in the chart. You need to be able to read it and explain it to a 5-year-old boy. If your boy will understand what's on the chart, then you've done a good job. If it's so complicated that probably not even yourself understand it, you have to work on it. So here are two charts. The one on the left, for sure, it can identify very, very specific points, turnaround points, etc. But it's so complicated, hard to understand. While the one on the right is a simple consolidation in a triangle, which helps you to say, I see, I know when it breaks out, I know approximately how far it's going to go. I've tried lots of strategies. I've backtested hundreds of them, and this is really the core message. Don't go for things that are too complicated, things that you can't understand. Try the simple methods. They usually work best. Multicollinearity, that's another thing. People, they learn about indicators, and then they start adding one after another on the chart. But this actually doesn't help. It will more confuse you than help you. Because many of these indicators, they have the same basis of calculation. We group them together, momentum, trend, and volume. Then we say, use only one per group, add it to your chart. That keeps your chart very, very simple. Think about if you have a moving average, a double exponential moving average, triple, flat, whatever moving average, time is still a moving average. So if you get 3 times the signal, no, it's actually just one signal, because they all come from the same group. So here we come to the tools again. If you use the tools but in the wrong way, it's not going to help you anything. But if you apply the right tools at the right time, you will have great outcomes. Very important, protection. If you invest, always use a stop loss. I have this discussion with my colleagues sometimes, like, no, you don't need to have a stop loss, and yes, you need, etc. Because they argue when you're in a position and you get stopped out, but the stock will continue to go up. So why do you have to stop loss then? But that is not the problem with the stop loss, it's like how you set it, which stop loss you set, etc. This chart takes S&P 500 in a very simple strategy. One is you simply buy and hold it forever. One is that you miss 10 worst days per year, and one you miss the 10 best days of every year. And you can clearly see the one where you missed can first days of the year has by far the best performance. So this is the confirmation for me that if you miss the worst day of the year, because you have a stop loss, you protect your portfolio from experiencing those bad days, then you're gonna have a much better performance over time. You also need to keep in mind there are a lot of bubbles out there. Here's a summary of the past bubbles, and there's many more, but those are probably still very relevant. Right now, we start to build up something in artificial intelligence, and many of these stocks, anything related to artificial intelligence is just going up. But many of them also start to come down again. So you need to be aware of like, where are we? How long are we going to continue up, etc. This quote says, while markets for a stock can remain erratic for a long time, it cannot sustain those record valuations forever. I also use trading stop loss, just like David showed in these examples. But there's not the one and only stop loss. It can be a fixed stop loss, it can be a trading stop, 8-year stop, or even a combination of stops. When you start to research about that, there's really great things you can achieve. By the way, this is the Oprah chart again from earlier in the slides. So you see it's going up until $28 actually. Then in one day, there was a huge sell of nearly 30%. If you're an investor in that stock and you don't have a stop loss in place, then you wish you had, because that would have protected you from a big loss. Persistence. That is also very important. Some people, they invest into a stock, may that be Nvidia, Tesla, or whatever, and they're just lucky they buy the right stock. It's going to go up a lot, and they say, oh, I know how to invest. It's very simple. But the actual trading consists of many, many small stocks. I like this quote from John C. Maxwell: small disciplines repeated with consistency every day lead to great achievements gained slowly over time. So if you are a successful trader and you add small profits to your portfolio every now and then, you'll be surprised what a big performance you can achieve after a year and over a long time. It's very important. Trading is not something you can just buy and sell and one time you'll be rich. It is hard work, but it's absolutely worth the efforts to learn it. So I say, don't be like Joe, don't do a chaotic thing, use a systematic approach to trading, and I will show you like how I do it. When you want to invest, the first step is you need to find a seller, something to trade, something that you can invest. In this example, number one, I think we have a shoulder pattern. Many people learn about books, what it is, statistics, how far you can go, etc. But just because you identify the pattern doesn't mean you will enter the pattern right away. We're going to be mistake number one. But step number two, you will wait until you get a signal. In this case, it's like the break of the neckline that will say, okay, now we start a downtrend resulting from potential patterns. Now you have a position in the market, but you don't want to leave it to the random moves of the market. You want to protect it from unforeseeable happenings. It can be economic numbers, it can be anything that completely reverse the market. That's why we add stop loss. You protect the position. And as you're in the position, you will update the chart over time. It can be done daily, it can be done weekly. Just you need to update the chart over time and also adjust your stop over time. Finally, the last point is number 4. Either you will be stopped out or you get an exit signal, or you will just close your position. And so one successful trade is done. This is like the small step I was talking about before. This you will basically repeat over time many, many times. then you make the portfolio grow. Trading tools. Very important. It's of course nice to have a screen like that with many blinking signs, but for me it's more confusing. I want to keep it simple. I just basically need 1 or 2 screens where I see buy or sell. In today's IT, you can code everything, that all the complex information you have will result in a very simple information. And I'm going to show you 2 tools. One to actually avoid losing money, and one to earn money. The first mistake I see often is that people use indicators and oscillators at the wrong time. Indicators are for the trends, oscillator are for the sideways or trading range. How do you know when to use which one? There's a simple tool for that. It's called the directional movement index. The one that you see below, the fat black line, it is said when you're above 25, you're in a trend. When you're below 25, you're not in a trend, you're in a trading range. Now, this cannot be always such a precise thing. It can be that you're about 24 and a half or something, and it starts going up, or the other side thing. But in this example, you can clearly see when you're on the left side, the fat line is always above 25, then you use indicators. While when you're going below 25, then you use oscillators. This particular example I will use in my own trading approach later on. The second tool I want to show you is about Bollinger Bands. Who of you is using Bollinger Bands or knows about it? Okay, good. Bollinger Bands are volatility bands that are drawn around. Okay. So the Bollinger Bands are drawn around the moving average, simple moving average. They're volatility bands, and they show you that about 94% of all market action is encompassed within those bands. This is the standard setting. What you see, the blue curve here on the left is the Gaussian curve. Maybe it rings a bell for some of you from math back then. It's 2 standard deviations to the left and to the right that encompass 95% of all market action. But I said, why not tweak it a little bit up and go to 3 standard deviation, which is 99.7%. It doesn't matter if it's exactly 99.7 or 99.5%. I'm sure John Bollinger will have slightly different numbers. The point is that it will show you a place where the market is at the very, very extreme. So I just simply turn this Gaussian curve to the right, and now you see in this bar that has a very, very high tail, we are far out of 3 standard deviations. I translate this statistical stuff into what the chart is trying to tell me. The chance for the stock to stay up there is like less than 1%, while the chance to go down is more than 99%. So you don't want to buy this kind of stocks where the odds are completely against you. This is a perfect time when you can actually short it. Just like in this example, it's again Oprah, the AI browser. I've drawn the gray lines, 2 standard deviations, and blue lines, which are 3 standard deviations. And when you're so far outside, this is like a scalping method. You can enter a position quickly, and it doesn't mean it's going to revert like here, all the way down. It only means that it will go back inside 3 or eventually 2 standard deviations. This happens quite frequently, actually, when you code it and when you use it on the charts. You will be surprised how often it happens. And the statistics, the odds, they're really in your favor. You can really make good money just with a simple tool like that. Now, I don't want to use a method that can only apply at certain situations in the market. I want to use a public, available, popular tool, the MACD, moving average, convergence divergence, which can apply just to anything out there. I don't want to go too much into the details of the setup because we're too much time. But who of you is familiar with the MACD indicator? Okay, fair enough. Well, this is the way it is set up. The crossovers of the two lines, they usually generate signals, buy and sell signals, while the crossover of the zero line is a confirmation of the direction of the trend. If you plot this into a chart, you will see there are plenty of signals coming from this indicator. The good thing is you have plenty of signals. The bad thing is probably you don't have time to trade this often. And the also bad thing is that when you're around the zero line, it creates a lot of whipsaws. In a nutshell, you can apply to anything around the zero line. You don't really get good signals, actually get often very bad signals. And how to solve that is simply to define a neutral zone around the zero line where you don't trade, where you simply ignore every signal that you get. So I drew a neutral zone around here, and I marked two signals that I ignore, that I don't trade. And you see, yes, it was a good decision not to trade these two signals. And I also added the DMI, just to show you again, here again, exactly the DMI is below 25, indicates there is no trend around, and that's why it's not really useful to use this indicator. Here's another example where the DMI rested below 25 for a long time, and basically could ignore all of those signals marked here in the red zone. So this is why I don't like to apply trading strategies that fully automatically buy and sell. You need to understand what the strategy is doing. If you just trust your money in a strategy like that, with all the broker spread and commissions, you will lose a lot of money in this particular period. And what happened here? I applied the very same levels to Forex, and you see now we have one big neutral zone. You have zero signals anymore. Why is that? Well, because the scale on the right is completely different from the one I used before on the index. So if you have a neutral zone, it filters out some open signals. The problem is how to define the neutral zone, because every asset, every underlying is different. And the solution comes from my colleagues, Alex Spiroglu from the STA, who simply utilized volatility to standardize the indicator. It's called MACD. V stands for volatility. It's the same setup as the MACD in its basic version, but you divide the MACD line by volatility, while volatility is the average true range of the past 26 patterns. This is how it looks like, and the good thing is now this indicator becomes very easy to read. You have a neutral zone between positive 50 and negative 50. When you're above 50, then you enter an overbought or bullish zone. When you're above 100, it's very, very strong overbought. So if you get a reversal on that level, it's very, very likely to change the trend and go in the opposite direction. Here I have an example of Tesla, and you see on this daily chart, you don't get too many signals, but they're quite precise. It's very easy to read. Beginning of 2023, buy signal. In March, had a sell signal. The one in between, marked with the red X, is exactly the neutral zone that you should not trade, you should not pay too much attention for. In mid-June, yes, there was a sell signal, but it was also divergence building up, so it was a bit early. It's very easy to read, you can apply for anything. The problem is it's based on a moving average, and so it's lagging in time. The solution to that is what we call the zero lag MACD. There have been some smart people who literally calculated the lagging part out of it. And well, the formula for it, for the zero lag MACD, easy to remember. it's not that complicated, but we're getting close to that. That's the actual formula. So I don't want to bother you too much with formulas and how it's being calculated. You can find it all on the internet. But as we apply the zero lag now in the same chart again, you will see that you get very, very well-timed entry and exit signals. The problem is that sometimes, because it is such a fast indicator, sometimes it can happen a bit too fast while you're still in the trend. So how to solve that issue? You simply combine both of them together. It's not so easy to read it in the beginning, that's why I choose some easy examples to show you. Here you see a number one, you got a crossover of the zero lag MACD, and soon thereafter you saw a crossover of the MACD. Both were on the same side, on the same low level, that indicating a bottom. They don't happen always exactly at the same time. There can be a little lag in between. That's why I tell you, don't just look at one signal, look for more confirmation of your trading idea. In this example, it worked very well. Both of them established their signals around $120. Soon thereafter, we can rise it a lot. Bitcoin is also very nice. Here, this is a weekly chart of Bitcoin. In November 2021, both of them rolled over and started to go down. In that time, we were something like $55,000 to $60,000 per Bitcoin. You all know that now we're about halfway of the value down. You also see that when you combine the two, in the second example, that you have a zero lag confirmation of an uptrend already while the MACD is still on its way down, but it's also in the neutral zone. If I don't have both confirmations, then I don't trade. If they are contradicting, if they say different things to buy or to sell, then I don't do. The same is true about the later points in July. We got a buy signal from the MACD, a zero lag MACD, while the MACD never really crossed over. So you only have one signal. Again, even if I miss a chance to invest, I don't do it. Because it's better to invest in safe chances, opportunities, rather than to invest and be sorry. I'm a fan of the multiple time frame approach. Multiple time frames can be explained with your watch. Your watch has 3 pointers. You have the hour, minutes, and the seconds. It's the same for long term, mid term, and short term. And when you combine them together and they all tell you the same thing going on, then you make good positions. This chart, for example, it looks very, very the same. The behavior of the lines, they look like they're more or less identical, so you could expect the outcome of it to be the same too. Actually, it was just one time frame, you don't know what's happening in the overhead time frame. So the outcome of those two would be completely different. I also love to explain with this chart, multiple time frame analysis always is top down. Look at the goat creating a small little wave. This one is going down to the lower time frame, creating a bigger wave for the yacht. But for the stand-up paddler, basically in the very short time frames, it's tsunami coming straight. So you cannot ignore what's happening in the overhead time frame. When you have, for example, in a longer time frame, you have a buy signal. In the lower time frame, if the sell signal, simply combine the forces together to see what is the result of the force out of it. In this case, the sell signal in the lower time frame, it's less strong. It will weaken the signal you get from the overhead time frame. On the contrary, if both say the same thing, you have the lower and the higher time frame saying buy, it will combine actually make a much stronger signal. So here's an example. we have Tesla on the daily chart, and we have crossover, we have a buy signal on the daily chart, while in the weekly chart, we have still a downtrend. So this buy signal made a small little move up of 5%, and yeah, it's not too strong. However, in this example, they're both on the same side, both say buy stock, and the resulting move out of it is much stronger. This principle applies to just any other stock. Here again, you see like when they're on the opposite, just look at the green lines. In the first example, you had a buy signal while the overhead time frame is still going down. It hasn't bottomed out yet. But in the second example, you had a buy signal in both time frames, and the result of course happening thereafter is much stronger. NIO is the Chinese electric vehicle maker, the competitor for Tesla, as they say. It had a huge run up. In the first example, you had a sell signal on the daily chart, but the weekly chart was still continuing. So you have only a small signal and continue to run into a bearish divergence. But look at the second, the red line, the red vertical line. Here you had a sell signal around $60, and the weekly signal has also confirmed that. Now we have gone down from $60 to about $10. This is an early warning to get out of the stock and can help you to save a lot of money. Hope we still have time for a few questions and answers, so feel free to use the opportunity. Eddie.
Are there any markets you don't like using technical analysis on?
I don't like markets that don't provide liquidity. It's not a specific market, but any type of chart that doesn't provide liquidity. Then it's like you ask a 5-year-old boy to draw a chart. This is about how much information you can get out of it. But if you have a lot of liquidity, that's why I love to trade indices, forex, or any of the liquid stocks in America. But it can become very difficult to trade small caps or anything that's just traded like once in a blue moon.
When it comes to the population, we start on population, this is very much. This problem is there the like bit. But we're still trying to promote it online here. Is there any kind of use to us how we can impact it on so that we can use it and show it the target with some information.
Well, you can apply technical analysis to just anything. I'm not so aware of what you trade mostly. I can assume that you trade accessibility to American markets, European markets, etc. My journey started with the first book reading about technical analysis, and then slowly getting into tools that are available online. The important thing is that only invest what you understand. If you just read one tool and then try to apply tool which is not anything, it's probably not going to work very well. Yes.
I'm an economist, not technical analyst, kind of professor. So I have one question: all these tools, different tools and mechanisms. Is there any tool in chart mechanism which is based on the different determinants of economic and social variables? Was demand, supply, the whole changes. So this we are not talking about the cost, we are talking about the effect, but we cannot ignore the cost. What if you have different markets, different sectors, depending on 30, 40, 50 variables? Why could not make a chart depending on changes in these variables? Is there something similar to that?
There are plenty of charts available, but that's not the basic idea of technical analysis. You
But
can
it was technical, you have different technical determinants.
It's actually what fundamental analysts do nowadays. They use all those indicators and start drawing them in a timeline. Yes, but that's when it comes to technical analysis. For me, whatever happens out there, whatever economic decision, interest rates, etc., finally it all manifests in price. I'm just here to read the price and make an analysis out of it and see what will be next. So for me, actually, I don't really care too much about all those economic numbers and how they perform. I can read the same information probably faster out of the chart here.
No, but okay. There are information to substantially change your position. For example, you're following the pattern. There are
Yes.
changes like this today, inflation or changes in or this, how to say, Ukraine, Russian conflict, etc. The changes substantially your outlook. So you have to somehow have at least, because the amount of the people probably somehow connected to the economic and social situation. Or supply.
Well,
Please forgive me. I'm not,
no problem.
I'm not in your area of working, so maybe I'm not exactly understand.
Yes. I give you an example, interest rates. When you raise the interest rates, it doesn't just affect the economy in general, it affects really tech stocks because their future earnings are discounted by the interest rates down. So whenever interest rates are going up, tech stocks will be hurt first. Typically, you can see what's happening, the change in momentum of price indicates already very well what's going to happen on the interest rate thing.
Okay. Okay.
Then you take a position, but because you're not 100% sure, you also stop.
It's complication. Can I just add something to that? The things you're talking about are lagging indicators. Inflation is what it was 3 months ago. It's not what it is now. The GDP is on a quarter. It was the last quarter, not the quarter we're in now. And all those factors are lagging indicators. Technical analysis is looking forward. We're looking at the situation now and saying, these are the opportunities forward, not what it was based on 3 months ago. There's so many, and then you have a lot of times when data is adjusted. You have non-farm payroll in America, famous for being adjusted all the time. And then the market moves. This was non-farm payroll from a month ago, which was adjusted from the previous time. So it's not apparent to what is going on now. But people like simple answers to complex problems, and so they follow them.
This is about finding opportunities in vast area of fields, not going deep into fields and do computational analysis in details. I understand it like that.
Maybe I could summarize it this way.
Yeah, but for example, changes in the labor market. There's not a change in the labor market. There are irrational.
But it's old changes. These changes already happened months ago.
For the next 10 years. So
But you're moving their estimates going forward, whereas we're looking at the situation of what is happening right now.
Okay. Thank you.
Sorry?
Those fundamental changes are important, like change in labor costs, etc. But again, all will manifest in price in the market. We cannot have more than price in the market. This is what is the basis for a trading decision. And that's why, again, if you know how to read the price behavior, like I said, they have the curve, because those economic numbers, they're being updated once a month, once a quarter. It's like a real postcard from yesterday.
It's the most rational business. Yeah. Yeah. Thanks. Listen.
No, sorry. Can you share your reading list with us? At least 3
Sorry?
reading list. Can you share with us your favorite books?
Yes, I have it on our website. I'll share it with the team as well. It's an official reading list of the IFPA that is valid for all the organizations. Contains some great books covering all those different methods.
If I may add something that, for example, what we were talking about, one example that really sums it up as is that the stopping of uptrend never going to happen. Meaning that the price always, people know, there's people that are smarter than everyone in this room because they are close to the situation. So basically, for example, the work unemployment, for example, people on the floor in the factory will know the moment the orders dry up. So basically, what happens is every single stock that every company that goes bankrupt, the price first starts falling, then suddenly the news comes out and it goes bankrupt. The same is with every news. So the price actually, because the people know, the price is the first to show something. That's the logic.
I would say, I always say good news happens in our friends, bad news happens in down.
No, but you have to know what kind of use you have to expect. So I'm confident with the future.
But everybody else knows that too. So that's in the price. So all the expectations.
It's in the price. It's part of the knowledge.
The price for estimation is market.
When you expect something, you don't know how the market is going to react to your expectations. For example, a good example in this case is NVIDIA. NVIDIA was in a very, very high, long uptrend, and then the long anticipated earnings came out, and everybody thought, like, wow, they must be at least this high. What happened is the actual earnings were much, much higher than the market expected. So on the opening, boom, it went up nearly 10%. By the way, it went outside of 2 standard deviation of Bollinger Bands, perfect time to short. And exactly this is what happened. While the news was super great, they couldn't reverse it within a day, and next day it goes lower. So it's the difference between what you expect and what's going to happen, what should be, what's not, but finally everything comes down to the price.
This is exactly the reason, because of the indicators for NVIDIA, exactly, because they have planned production and they cannot meet the demand. So what you actually see is a plateau. So they won't go beyond what it is now because they cannot produce more. And the stock is so much short now.
That's your opinion.
But they can
See the price.
Yeah.
Exactly.
It's when everybody else thinks that, then it can go.
I'm just articulating.
That's
Okay, I'm glad to see I triggered some discussion here. And we continue this discussion throughout the conference or after the conference. Feel free to approach me and argue in my favor or against me. So I say thank you for your attention. Thank you for having me.